Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. Last week's meeting of the Federal Reserve's Open Markets Committee, or FOMC, may have marked a turning point in the monetary policy response to COVID. Before the June meeting, the Fed's policy response has been to keep interest rates close to zero, to keep the markets well supported through $120 billion per month of asset purchases, and to add liquidity or cash into the money markets as and when it was needed. All of which was designed to keep the markets and the economy ticking over and to give them the best chance of coping with and recovering from the shock of COVID-19. Critics have argued that the patients being treated have fared far better than what was originally expected, and that now is the time for the Fed to reduce its support and head back towards a normalized policy response. Because if they don't, they risk killing the economy with kindness, or at least creating an environment where its temperature can get dangerously high, fueled by a combination of easy money and higher than anticipated demand. That could mean that high levels of inflation return to the U.S. economy. This in turn could put the Fed on the back foot over interest rates, which may then have to rise sharply to restrict the supply of money and curb excess demand. Many of us have never experienced double-digit interest rates. For most of the last 20 years, base rates in the U.S. have been below 5%, and for the past decade, they have only rarely been above 2%. However, we only have to look back to the early 1980s to find a period when U.S. interest rates touched 20%, driven in part by a rate of inflation that ran as high as 15%. The rate of inflation right now is well below those eye-watering levels. However, it did reach 5% in May, which is very close to its 25-year peak. Turn the tap off now, say the hawks in the market, and stop flooding Main Street and Wall Street with easy money, because frankly, they no longer need it. We can get some idea of just how much excess cash there is in the system right now by looking at the Fed's repo operations that the central bank uses to manage the amount of liquidity within the financial systems. When money is tight, the Fed adds liquidity by lending money against eligible securities pledged by banks. But when money is loose, the Fed takes cash off of the bank's hands in what's known as a reverse repo. Last Thursday's repo operations saw the Fed suck up a record $755.8 billion in cash, money that the banks didn't need or want and were happy to park elsewhere. This was the second time in a fortnight that the Fed had attracted record amounts of cash from banks. On June 6th, the Fed scooped up $485.1 billion in a reverse repo operation. Decision makers on the Fed Open Markets Committee seem to have taken note, and the statement and data from the policy meeting last week showed that 13 out of the 18 members of the committee favored at least one interest rate rise by the end of 2023, and that 11 were in favor of two. Quite a change from the wait-and-see approach that the Fed has previously adopted. However, the end of 2023 is as far as 2.5 years away, so while the Fed has indicated that interest rates could rise, it's effectively said that it's unlikely to be happening anytime soon. The reaction in markets to the Fed meeting was almost one of confusion. For instance, equity markets, initially sold off on the prospects of higher interest rates, stabilized on Thursday, before a much larger sell-off on to the end of the week. The S&P 500 finished the week down 1.2%. The Dow was down 3.7%, while the S&P Mid-Cap 400 and Small-Cap 600 indices were down on the week by 5.1% and 4.7% respectively. The big hit to small and mid-cap stocks tells us that investors think the rotation into value has come to a halt. Value stocks, of course, were seen as benefiting from rising interest rates and the reopening of the economy. The fact that the NASDAQ 100 and NASDAQ Composite indices were largely unchanged last week suggests that money went back into tech names. So that despite the Fed's supposed change of tack, the markets believe that interest rates are staying lower for longer, a state of affairs that favors growth stocks. If we need further evidence that the markets don't believe the Fed's change of direction, then we need only look at the chart of 10-year Treasury yields. In a market where interest rates are expected to rise, bond prices should fall and bond yields rise. However, as we can see from this chart of 10-year yields, following an initial spike after the Fed meeting, 10-year yields have fallen once more, and indeed, over the last month, they are down by 0.24%, the exact opposite of what interest rate hawks would have expected to happen. The hawks may now have to wait until mid-July and the release of the June inflation data to make their case again. But as things stand, their pleading could well fall on deaf ears. That's all we have time for this week, but as usual, make sure you do your due diligence before making any investment decisions.